The simplest and easiest way to think about this is effectively currency is nothing but a commodity. Right? Why do we need a currency? Of course, we need currency within a country to exchange goods and services amongst each other and a store of value. But when it comes to two countries or exchange between two countries, it's really the demand and supply of one currency versus the other currency, which creates this, this sort of relative demand and supply between the two currencies. So, for example, in India, we are, let's take the example of India and US again. We are importing stuff from US. Let's say we are importing defense equipment from US, right? So, we need dollars for that. On the other hand, US is actually importing services from India. There are a lot of KPOs, etc., who are based in India who are providing services to US companies. And when US companies need to pay for that, right, so they need to actually procure rupees for it, and hence there is a demand for rupees and there is a demand for dollars. Now, what outweighs what? Whether you need more dollars or whether we need, the outsiders need more rupees, determines the exchange value between the two currencies, right? So, effectively what has happened is over a period of time, over the last say 20 odd years, there has been relatively more demand for dollars as compared to demand for rupees, which has led to the value of rupee depreciating against dollar. Right? So, in very simple way to think about this is the cumulative demand surplus that we have for other people's goods, other countries' goods, which has resulted in this rupees exchange rate depreciation. Now, there are several economic theories which go into this, and one of the economic theories is basically to say that if one country has a higher inflation rate as compared to the second country, country A has a higher inflation rate compared to country B, then country A's currency will be basically depreciating over a period of time versus country B. Right? And you know that historically India has had a far higher inflation rate as compared to US. US has historically been around 2%, India has been between 4 to 5%. So, one way to think about this is that the inflation difference between the two, which is about 3 to 4%, is the average annual depreciation of rupee that we should expect. And if you cumulate that over a 20-year period, you will come to broadly the same answer, which is to say that rupee should actually halve in value versus US dollars.